Welcome to The Explainer. Every single day, the market is throwing a ton of signals at us. So today, we're going to cut right through that noise and figure out what's really going on.
So, how healthy is the economy? Really? I mean, one minute you're hearing about growth, the next it's all doom and gloom about a slowdown. It can give you whiplash, right? So let's piece this whole puzzle together and see what's actually moving the needle today, Friday, August 15th.
All right, first things first, let's zoom out and look at the big economic picture. And honestly, right now, it's a total tug of war. We've got two huge opposing forces pulling the market in different directions. Okay, so on one side of that rope, you've got this, a 3% annual growth rate for the U.S. economy last quarter. Now, that's pretty solid, especially after the sluggish start we had to the year. It tells us that, hey, people are still out there spending, businesses are investing, there's some real strength under the hood.
But yanking hard in the other direction is this number right here. Only 73,000 new non-farm jobs last month. That was a huge miss, way below what everyone was expecting. And this is a big deal. It's the first major sign that the super hot labor market, the thing that's been holding up this whole economy, is finally starting to cool off.
And you can see this tension playing out everywhere when you look at different sectors. I mean, healthcare, it's still a rock. People are always going to need healthcare, right? But check out everything else. Tech, finance, you name it. They're all getting slapped with a market perform rating. And you know what that really means? It's basically Wall Street's way of saying they're just treading water. It perfectly captures that uncertainty we're feeling across the board. Okay, so that brings us to the main event for today. We've got a whole series of government reports dropping. And believe me, every single investor out there is glued to their screen, just waiting for any little clue that tells them which way this whole thing is going to break. So think of this like the day's economic report card being handed out piece by piece. First up, at 8:30 this morning, we got retail sales. That's our direct line into how much people are spending. Then, boom, 9:15, industrial production hits, telling us how busy our factories are. Every single one of these is another critical piece of that big puzzle we're trying to solve.
But it's not all about the big government numbers. We're also getting a health check straight from the horse's mouth. Companies are reporting their quarterly earnings, and they're really strategic about when they release these numbers. It's always either before the bell or after the bell. And there's a good reason for that. It's not random. It gives everyone, from big investors to the trading algorithms, a little bit of breathing room to digest the news before the absolute chaos of the trading day kicks in. So, this morning, before the opening bell, we heard from companies like Flowers Foods. You probably know them. They make nature's own bread. Now, a company like this is super interesting because bread is a staple, right? So how they're doing gives us a really good read on the average person's budget. The big number everyone was watching for was 29 cents per share in earnings.
And then later today, after the market closes, man, we're going to get a wild mix. I'm talking about a really diverse group here. You've got Trump Media, you've got Barnes & Noble Education, and even a niche electric vehicle company called Green Power Motor. Each one tells a totally different story about a different corner of the economy. Okay, so we've got the big macro data. We've got the nitty-gritty company reports. The billion-dollar question is, what is the market doing with all this? How is it digesting all this conflicting info? Let's check its vital signs. All right, let's take a look across the board. Oil's up a little, gold is down a bit. But honestly, the number that I'm laser focused on is the 10-year Treasury yield. It's holding steady at about 4.29%. And why does that matter so much? Because that one little number, it's the foundation for interest rates on everything. We're talking mortgages, car loans, business loans, the whole shebang. Something really interesting happens when the overall market is just kind of stuck in neutral like this. It creates what people call a market of stocks, not a stock market. And what that means is, the big picture fades away and it's all about individual company stories. And that creates some really clear winners and some pretty brutal losers. So, who's in the winner's circle today? Well, you've got Fox Corp, which is just soaring because their ad revenue was way better than anyone thought. And then there's Gildan Activewear. They got this massive boost when they announced they're buying Hanes brands. It just goes to show, in a market like this, if you've got good news or you make a bold move, you get rewarded. Big time. But yeah, the flip side of that coin is absolutely brutal. Look at Snap. It's hitting new 52-week lows because its earnings were just a big disappointment. And Alight? They basically told investors to expect less money coming in this year, and the stock just got hammered. It's a clear message. Any sign of weakness, and you are getting punished. No mercy. So let's just recap for a second. We've got a growing economy, but a weak job market. We've got some stocks hitting all-time highs, and others hitting all-time lows.
It's chaos. So how in the world do you make sense of it all? Well, traders love their tools, and some use specific indicators to try and get a clear signal through all the noise. Today, we're going to look at one called the Mannarino Market Risk Indicator. Okay, so what is this thing? Basically, it's designed to take the temperature of the financial system, to measure stress, and it does it by mashing together two really powerful things. First, the strength of the US dollar, the ultimate safe place to park your cash. And second, that 10-year Treasury yield we talked about, which is a great gauge for fear in the bond market. The whole idea is simple. If both of those are going up at the same time, it's a huge red flag that the smart money is getting scared and running for cover.
So you take today's numbers, you run the calculation, and what do you get? A score of 262. But, okay, 262, is that good? Is that bad? What does that number actually mean?
Well, here's what it means. According to the scale for this indicator, anything from 200 to 300 puts you in the high-risk category. And at 262, well, we are parked right in the middle of that danger zone. It's basically suggesting that beneath the surface, under all the confusing daily headlines, the actual plumbing of the financial system is feeling some serious pressure. And that's the story as we head into the weekend. You've got an economy that literally cannot make up its mind. You've got a market that's ignoring the big picture and rewarding individual stories, and you've got a key risk indicator that is flashing bright red. So, it leaves us with one big question to chew on. In a market that's so completely split down the middle, which side are you paying attention to? The winners or the risk?